Gold fell for the second week in a row this week, the first time this has happened since May. The impact of last month's Federal Reserve announcement of open-ended quantitative easing has now well and truly worn off. Friday afternoon's London gold fix was $1,737, a 1.7% weekly fall. Friday's silver fix, meanwhile, was $32.33, down 4.3% from last Friday. Following the fix, however, gold and silver fell sharply, with gold hitting 7-week lows. This week started with Ben Bernanke giving a spirited defence of the Fed's quantitative easing policy. The Fed chairman expressed sympathy with emerging nations, some of whose policymakers have accused the Fed of exporting inflation. However, Bernanke denied the charge, saying that monetary easing in the West is not the main driver of cross-border capital flows, and that some emerging economies ought to consider letting their exchange rates respond more flexibly. He added that supporting growth in advanced economies was good for the rest of the world too. This is a man who is committed to current policy and who shows no sign of changing course. Over in China, official GDP data shows the economy slowed for the 7th consecutive quarter in the 3 months to the end of September. Chinese Premier Wen Jiabao said the economy shows signs of stabilising but warned of difficulties in the 4th quarter as sluggish global growth weighs on export demand. Here in Europe, the latest European summit ended on Friday with most of the big issues still unresolved. There was some agreement on the creation of a single Eurozone banking supervisor, but plans for the direct recapitalisation of banks seem to hit a wall. Anonymous French sources briefed the media on Thursday to say that the European Stability Mechanism may be able to inject money directly into banks as early as the 1st quarter of next year. German sources, however, soon put out the word that this is very unlikely. On Friday afternoon, German Chancellor Merkel told reporters that any recapitalisation should not be retroactive. In other words, countries such as Spain and Ireland will have to pay for their banks' existing bad debts themselves, reinforcing the link between distressed banks and distressed sovereigns. Speaking of Spain, at the time of recording there was no sign of an imminent Spanish bailout, despite reports earlier in the week that the government was ready to ask for one. A Spanish bailout would pave the way for the European Central Bank to buy Spanish bonds in the market and thus help lower yields, something that is conditional on Spain agreeing to an adjustment programme. It may be that Spain is playing for yet more time in the hope of negotiating a better deal. Spanish borrowing costs have come down in recent weeks, while ratings agency Moody's confirmed Spain's credit rating as investment grade earlier this week. However, the only reason conditions have improved slightly for Spain is because the ECB is waiting in the wings. Sooner or later, Spain will need to make a move. Indeed, if they choose to do so on a weekend, this may have already happened by the time you watch this. If so, you can stop watching now. To keep up with the latest in gold and silver, visit goldnews.bullionvault.com.